Hello, welcome to the last chapter of Module 1, and I'll quickly brief about Module 1. So, Module 1 was about frequently asked question by common people like you and me who are either new to the market or have spent some time, but then still these basic questions keeps coming to their mind. And through these questions, I tried to explain some basic concept. I tried to warn you also against some of the malpractices. Then we became familiar with some terms, familiar with market also by addressing these questions, and like why market exists, why someone make money, someone lose money, different kind of risk. Now that you understand, you know why power of compounding plays such a major role, and that's why market is so volatile also. Then you also know now that without anyone help, or even without going deeper through ETF route, you can still expose yourself to investment in stock market. Then you now know that where you have to be careful in terms of opening your demat and trading account. You know the difference between investing and trading. You know that you cannot time market. It's one of the most difficult thing to do, and most of the people while trying the market lose money rather in this market. So there's actually the answer for what is the right time to enter and exit is something which we also heard in this module 1. Then you learned about different kind of stocks, different kind of approach, lump sum and SIP approach. Then you understood about who are the different brokers in India, what are the different type of brokers in India, and how to select one for yourself, and stay careful about that also. And the very last topic I have kept, which we will uncover in detail, is about, obviously now that you are comfortable, some of you might be already investing or even planning to start your open your demat account, must be wondering about one more thing for sure, that okay, I'm investing and there will be more people who will be investing, but who else are there who are investing into this market? So when we have curiosity about anything, we can have this kind of curiosity as well, that who are the other people who are investing, how are they doing, whether they are doing well, they are not doing well. We have heard that the stock market is gambling, so who are the other gamblers, so if it is gambling, we need to know who are the other gamblers. Well, they are not gamblers. This is what we will learn into this class. Okay, they are not gamblers, they are serious people, serious investors. They are doing a difference, making a difference. So what we have done, that we have made one Excel sheet for you people. I'm going to upload this also along with this class, and let's open our websites, NSE India and Money Control and Screener, correct? So what we have done, that for the very first Nifty 50 companies, Nifty 50 you understand, right? Now this is NSE base index is Nifty 50, which is having a list of 50 stocks in them. So what we have done, that we have tried to find out who are the investors into these 50 companies first. Exercise which you can do for your own observance is who are the people, or what extent, up to what extent those different people have invested into Nifty next 50 companies. So to start with, who are the other investors, we can call it shareholding pattern, right? So when we try to find the answer of this question, that who are the other investors, answer of this question lies in the shareholding pattern of any company. So very quickly we will first see who are the different type of investors into one company. So here you see, which is highlighted as promoter, FII, FPI, total DII and others. So these are four main category. We will learn about each of these category in detail. We will start with promoters, okay, and we will also see some of the trend. So now that I have opened Reliance Industries shareholding pattern, we can open one or two more and then see. And then obviously we have this shareholding pattern of all the 50 companies. So we will draw some attention from here as well. We'll give our attention here as well and draw some conclusion from there. Right. So let's first stick to just one shareholding pattern, which is Reliance Industries. So in shareholding pattern, you see that they display 4 quarter. I mean, a website like Money Control. Obviously, you can find the data for last 10 years, 20 years, or from day one. It is a public data. It will be available. But looking at the last 4 quarter, what we see that 50.05% of the stocks are being held in promoter's name. Means Mukesh Ambani and other people who are the promoter of this company, people who started. Reliance Industries was started by Mr. Mukesh Ambani father. He inherited this business and made this business better only day by day. It's India's one of the largest company. We should be proud of this company as well, the kind of revolution they have done from day one. All right. In between, some people can debate that they are into, some. Okay, let's skip that part. But yeah, this is one of the largest company. I'm personally proud of this company because they have done so many great things, and that's why probably they have given return also. This is one company who bought polyester to India. This is one company who made communication cheaper for everyone. This is one company who opened such a huge refinery, so Jamnagar refinery and many other businesses. Wherever they entered, they did a lot of revolution, which finally ended up helping people only, people of India, right? So that's why I have a huge respect that they are one company who have probably given best of the returns for its investors, made huge return for its investors, a company who made cloths cheaper for Indians, communication cheaper for Indian, so you can see that this company has actually done well also. If they have done so many good things, a company is probably the largest company. Oh, it is 10 lakh crore company now with the latest increase in the price. See, I mean 141 rupees stock going to 10 times return in last 13 years. However, if you go and see the historical data, this return will be much higher in much bigger with much bigger intensity, I would say. So let's go back to the shareholding pattern because this is the class about and not about Reliance Industries. Okay, so promoters are one people who are there as a shareholder as well. So when you are going to buy Reliance Industries company, you have to remember one thing, that Mukesh Ambani has also have the share in his name, right? Okay. What we can learn from here is the shareholding pattern difference. What we can see that Reliance promoters was having 47% and now they are having 50%. So what conclusion we can draw from here? Well, in 95% of the case, if you see this kind of trend, trust me, this is a very good trend. A promoter who has started the company, diluted the company share, and from 100% he come down to 35, 40, 50, 60. He has given away the shares from his name to retail people to raise money, right? Now, if these promoters started increasing their stake, it means they are doing well, the company is doing well, they themselves are doing well, and they have belief in the company, and that's why they themselves are buying their own company. I have personally seen that in most of the scenario, this is very healthy for the companies. I'm not saying that when you are going to buy shares, all you have to do is see whether shareholding pattern and the promoter share is increasing or not. But yes, I can show you a few examples. So let's say you have seen a very good example where a company has given excellent return, let's say in last 3 years. Even in last 3 years, you can see that they have given 3 times return, not even 3 years, it is just 2 years. From 2316 to 3 years. In 3 years, they have given 3 times return, which is a huge return, right? All right. So there is another company, Yes Bank. What you can see? You can see that their prices has came down like anything in last 1 year. Many of the investors have lost huge money here in last 3 years in Yes Bank. Okay, let's see the shareholding pattern of Yes Bank. So Yes Bank shareholding pattern. Promoters had 20% approximately, now they have 13%. Vice versa of Reliance Industries. Here promoter share is getting increased, and here you can see that promoter shares is getting decreased. Well, when we are trying to understand this part, that promoter share is a good significant 50% here and just 13% here, let's also try to understand how this would have happened. Okay, and to understand this, I'm going to explain you one concept or practice which happens in stock market. Is called buyback. So I'm not going into the technicals of it, I'm just going to tell you some example. So the example is, you are holding a share ABC. Now company has share is trading at 300 rupees. You got 500 shares. Now company is making huge profit. They have no place to invest further. What they will do? They will give dividend, good dividend to the investors, right? I should write here good dividend, but they may not give all the money as dividend. They still have surplus cash. What can they do? One of the practice which they do is, they say that okay, the share price is 300 rupees, we can buy back at 330 rupees. Means company will give an offer to the existing shareholder, that it is not a very straightforward rule that always it will happen like 10%, but generally in buyback companies give higher price than the market rate. Okay, and this option is only for the existing shareholder, but then they can also include a clause where all 500 shares what you have, you cannot surrender that in 330 rupees. So they can say that okay, 10% of the shares from every shareholder we will buy back at 330 rupees. So you are having 500, now you got an opportunity that you can sell 50 shares back to the company in 330 rupees. This is another way of rewarding the shareholder. At this point of time, consider this, you gave your 10% of the share, but promoter, he also have the shares, he didn't participate in it. He said okay, I have shares, but I'm not going to sell it, I'm not going to surrender it back to the company. Promoter share is different, company share is different, your share is different, the way you have shares, similarly promoter have the shares. You decided to surrender back, so you come down to 450 shares. But if promoter also have the similar 500 crore shares, he had an opportunity also to surrender back the shares, but he didn't surrender. So in this case, obviously his shareholding will go up, and similar kind of situation was happen in Reliance and other companies. Every time they go and buy back, and if promoter don't surrender his shares, his shareholding will go up. The idea is to explain you buyback. We will learn about buyback later as well, the whole process, that how the pricing get done and why they do it in unusual scenario. But this is what is called buyback process, where company can give a premium with a clause that 10% or 15% or 20% share existing shareholder can surrender back to the company with a premium from the market price, right? So now now that we know these are different type of shareholders in the company, you also know that this is a good trend where promoter share is getting increased. It means people who are running the company from the front, they have better confidence into the company, they have confidence into the company. Okay, and promoters confidence is important because they are the people who are running the company. Let's go to the second row. It is written pledged. So this is a case where promoters put their own stake in hand of lenders to raise money. So they can pledge their shares to people who can give them money at they can give them debt basically at certain interest rate. So when promoters are in deep trouble, when the company is in deep trouble, what they do that they pledge the share of the company or pledge the promoter shares. Promoter himself pledge the shares, raise the money from the market on debt with that anticipation that they will make the company better, and they buy back the shares from the company from other people who are selling. So a lot of things happen where promoters can pledge their shares as well. They can also pledge for the personal purpose, where they may think that okay, I'm running this company, I got shares worth 500 crore, let me pledge it, raise 250 crore and start another company as well. But that is again a bad sign. If a promoter is pledging his company and raising money, obviously there is some trouble inside, and most of the time that trouble is real. Okay, again we can compare here. You can see a company which is given 3 times return in 3 years have zero pledge shares from the promoters, and on the other side a company which has crashed from 400 to 50 rupees, almost crashed by 90%, they have pledged their shares significantly well, from 3%. Initially they started with pledging 3.6%, now they have pledged 35%. Okay, so this is another learning we have, that every time we are going to invest into a company, we will at least see this part also, whether the promoters have pledged their shares or not. Okay, no, I'm not giving you a hint here or telling you that this is always correct, but yes, in majority of the situation you can also assume it in a common life, even in our own life. Let's say we got assets and we have to pledge it. Obviously there is some trouble, that's why we are pledging our asset, right? And that trouble can pull us down to any extent, so you have to be very, very careful in terms of looking at this number also. Second important concept we will learn about is FII. Who are FII? So people, FII full form is foreign institutional investor. So any institutional investor sitting outside our country is called FII. They come to our country because they think that they can earn better return from India, since it's a growing economy and their economy is much bigger, larger and stable economy, but they assume that the return can be better in India, and that's why they come to India and invest into Indian companies as well. Well, to understand the nature and behavior of FII, let's understand one more example here. And example is something like this, that first understand this part, that in India you have fixed rate of return which is 7%, means most of the bank is offering this 7% return on your FD. In US it ranges from 0.5% to 1.5%, right? So money is available there, money is scarce in our country. Now why they are giving this low? Because they are already an economy which has grown, and there's surplus of capital. It's a developed nation. So there, even if companies grow at 4%, they considerably understand that okay, instead of putting your money in FD, even if the company is giving 4% return, it's better. However, if you come to India and if in India, if you are investing into a share which is going to give you 4% return, you will never invest into there, right? Because you will think that why would I go there and take a risk with a company? I can get 7% in FD, which is non-risky. So this is the case here, that in our country, companies are expected to grow at higher rate than 7%, let's say 15%. Now this become a very good scenario for FIIs, where they think that in our country the growth of the economy is, now that we are already developed, there is very less scope of becoming more developed. Let's diversify ourselves and go into the growing economy, and they come to India and they invest for this reason. So they invest for this reason, right? But sometime you also hear that FIIs are selling, and not always, like FIIs are in a situation like this where they get better return on their investment. There are scenarios which go against them as well. Let's understand that also here. We have to understand the behavior of these companies, because then only you will become confident, that it is not that FII is coming and they are coming with only the positive part. That they are unhappy with 4%, they are coming here and invest, getting a return of 50%. So only good situation is there for FII, so they can afford to invest. I mean, this kind of query can come into your head. So you have to understand that for everyone there is some strength and some weakness. So what can go against FII? Let me show you one example. But before understanding that example, you know how much is dollar right now? Anything like 72 rupee for $1. For the sake of simplicity, let's keep it 70 rupees. Now, $1 was approximately 20 rupees in 1991. So when our economy got opened, from that time onwards, we have been depreciating our currency from a around 3.5% compounded annual growth rate. At that CAGR, dollar is appreciating against rupee. Means rupee is getting weaker in common language, right? Now this is the trend, and trust me, the way both of the economy is behaving, dollar rupee can go to even 80 against $1 and can get depreciate. Not can get, I'm sure in another 10 years, 5 years, 4 years, or at some point of time this will happen. This is bound to happen. Okay, there is 99% chance that it will happen. Okay, then because this is the trend which shows, this is the difference in the economy, the performance of the economy. If something miraculous happens, it may go to 65 again, go to 60 again for shorter term, but then in the longer run it may get depreciating only. Anyway, let's not become a forex trader at this point of time, but understand this situation that yes, from 20 it has come down to 70, and from 70 it can go to 80 also, $1. Now let's say one FII comes with $1 million, correct? $1 million is how much? It becomes 7 crore. Well, he invested this 7 crore rupee in Indian market. Great. Let's say 2 years passed, and he got this 7 crore become 8 crore. Let's say he got 13% return in a year, right? In 2 years. For you, 13% return is very less in 2 years. It's just like every return. But they can be happy that okay, I got 13% return, good decision that I came to India, I'm happy about it. But the moment they have to go back home, they cannot go with rupee, right? So one FII coming to India, he came here with his US citizen money, pension fund money, or whomsoever is the final beneficiary money. So when they have to go back home, they have to go back with dollar only. They cannot go with rupee. Rupee is of no use in US at that point of time. Their return will be considered in dollar return only. And let's say after 2 years, dollar goes to 80 rupees. So when he is going to convert this 8 crore rupee in $1 million in a dollar, he again gets back $1 million only. And what you can see here is even after 13% return, they made 0% return on their capital invested into India. So they have certain advantage that money is cheaper for them, but then they have their own disadvantage of investing into a country like India, where the base currency of that country has to go and keep depreciating against dollar. So people have their own piece of problem, whether they are, the only thing which I wanted to highlight by giving you and showing you this example, that all of them have their own piece of problem. It's business at the end of the day. Businesses have risk, which I again and again keep telling you. So even if you are deciding to invest into Indian stock market, you are not alone. There are other people who are going to invest, and they are equally exposed to different kind of risk. FIIs are highly exposed to the currency risk, currency fluctuation. Let's go back, now that you understand FIIs, who are FIIs, what are their challenges and what are the benefits for which they come to India. Let's quickly move to DII. DII are like institutions again, but domestic institutional investors. Biggest domestic institutional investors is LIC in India, life insurance company. Very quickly, you put your money into LIC, LIC go and invest that money into share market. Okay, LIC has been selling endowment policies where they promise you risk coverage and return both, and to give you that return, LIC also places that money into different kind of stocks, different companies' stock in Indian stock market, but they are called institutional investors. But what I consider that LIC has LIC is not having its own money. It's our money, right? So, though we put them together, both insurance company and mutual fund, into DII, if we simplify it, we understand that we are this, and we are this, right? So, apart from promoter, FII, and total DII, which includes insurance company, mutual fund, financial institutions, and other DIIs, what we see that we are kept here in the others. So, in most of the companies, you will see we are lying in that other segment, and we are this 11%, 8%, 8, 7, 3, 9, 10, 20, 0.6, 7, 2, 3, 1. So, this is we. In different top 50 companies, this is the participation from the retail side, which they show together. But if you ask me, I call that this is also retail, this is also retail. At the end of the day, this is our money. It's just that we give 100 rupees to mutual fund, they keep 2.5 rupees to managing that fund and invest that 97.5 rupees into the market. It is our money only which is going into the market, right? So, we have to be very careful here, understanding one fact, that instead of giving these companies the management fee, which are generally very high, if we learn the basic of investing, basic of portfolio management, basic of risk management, we can directly go and invest into a company like Reliance. We can directly go and create a portfolio of companies like Reliance, Infosys, TCS, and few other companies from other sectors, right? But yes, there are 4 category of people who invest into stock market. They are called promoters, FII, DIIs, and retail investors. So, in other segment, retail investors are there and some other people also. Altogether, it comes down to 100. To summarize, you have seen that if you see promoter shares going and increasing, it is a healthy sign. If promoters are placing their shares, it is a bad sign. You know the pain area of FII and the reason why they come here. And when you saw the DII, you also understood that in DII category, it's again majority of the shares in DII is the money from the retail people only, right? Because LICs and MFs don't have their own money. They collect that money from the retail only. Retail means people like you and me. But they are put together in DII category and we are put together in others. So, this class was about who are the different type of investors into stock market. Now that I have also told you to do a small exercise, this is one exercise which we have done and we found something interesting. What is that we found interesting is ICICI, ITC and Larsen and Torbro have no shareholding from the promoter side. So, is it possible that promoters don't have shareholding? Yes, it is completely possible that promoters dilute their shares so much that they become normal shareholders and comes in the other category itself. This is ICICI. It was started with Industrial Credit and Investment Corporation of India. This was a PSU, but now LIC is majorly owned by FIIs and DIIs, and Dodge and Cox International Stock Fund. This is one of the FII which holds major stock into. After this, LIC is there who holds good amount of stock in ICICI Bank. So, don't get worried if you see a situation like this where you see promoter is not having any any shareholding, and this can be still okay. I mean, even if promoters are not there, management is running the company and main shareholders are calling the shots. So, that kind of situation will be there. In fact, I remember for Infosys in around 3, 4 or 5 years back, anything between 2014 to 2015, Even in Infosys, why I'm giving you this example, because it was again a great company started by Mr. Nayan Murthy and his colleagues. Uh, if you see shareholding pattern here, there were 6-7 people. They started diluting early. Now they are having altogether 13%. So they themselves requested rather that they should be put into others category and not the promoters category, because most of them got retired. They made a rule that they will retire at 60. So most of them got retired. Their shareholding is also very low. So they themselves requested that they don't want to be called as the promoter of Infosys anymore, and shareholding pattern should show that promoters of Infosys are having now zero thing, and they jump back to the other normal investors, retail investors. So yes, you do not have to get worried if you see a situation like this. This is completely possible. That's why it is called a public company, that it can be owned by anyone. So if you go and crunch data, you get to know different information. And this is what we got when we crunched the data for 50 companies, and we thought it will be a good idea to tell you that there can be companies with no promoter shareholding and are still good for them. Well, this was the last class for our module 1, and I really want to thank you for giving me opportunity to explain you these things. In some topics I told you about market, some topics about malpractices, some good thing, bad thing, some assumptions, some myths. It was more to do with making you comfortable, giving you acquaintance with the terms of a stock market, and making the course also interesting. Now we will jump to the real learning topics, where we will learn few basic things, and we will build certain knowledge over those basic things, so that we can actually identify stocks to invest. So yeah, these were the fact, and this is all for module 1, and we will see you in module 2, which will be more about again building blocks of the course, basic economics, mathematics, Excel sheet. Now this is one course I have made for everyone, so I know some of you might be knowing those basic things, but it will be good to revise them. It will be again 30-40 minutes videos. Some other perspective you will be able to hear. I'll try to trying to bring good examples, common examples, so that doesn't matter from which background you are coming, engineering background or medical background or commerce background, you should be able to understand about the Indian stock market in a simple manner and still build a good knowledge over it. A knowledge did not have to be very complicated according to me, and this is what we'll be doing even in the further classes. Well, thank you very much. This was class 12, the last FAQ of module 1. But I want to add here one thing, that though right now there are just 12 classes, there might be more FAQs coming from the audience, where I observe that this is one question many people are asking and it has been not addressed. As I promised you all, I'll keep enriching this course, and if I ever come with more FAQ which I think should be put together in module 1, I'll put it there and inform you through WhatsApp number, which I have already shared with you, also through emails. But for now, this is all from module 1. Thank you. And as you know, there are doubt clearing sessions after module 1. You will get one email or WhatsApp message, and you can come and attend the doubt clearing session also. Thank you.